Yes, this video will be about the FOMC minutes. We'll get to that in a second. On the screen, you're seeing the first screen of a video that I'll be posting in the next day or two regarding the short report for ABR. I wasn't going to address it at all because it's just so hyperbolic that any serious investor, meaning the institutional market, would discard it instantly. It really wasn't written for an institutional market. It was written for a retail market. And it was written in such a way as to heighten emotion. So it's not very big on fact, but it doesn't need to be. It's written to heighten your emotion, especially fear, one of the most primal emotions, to get you to act. It is intended to make you sell your shares. So I thought about it, and I thought, well, we would miss an opportunity here to dissect a short report, to learn how to read one so that we can know what to discount and what to pay attention to. So I am going to do a video refuting the short report, but I'm actually going to use a short report that was written in the summer, early in the summer, I think in June, which I can tell by reading Viceroy that it was heavily informed by this short report. So there is one that was written in the summer that is more cerebral, that is more information, or at least the goal was to deliver information with a little bit of hyperbole, meaning a little bit of extreme language. Whereas the Viceroy report was designed for nothing more than extreme language, extremely hyperbolic. And some of the examples of hyperbolic writing I will cover. We'll go point by point over the more intelligent short report, and we'll refute each and every one of those points. And then we'll look at some examples. After you're done that video, by the way, you should be able to tear apart Viceroy in 30 minutes. The whole thing, you should be able to tear it apart line by line. But I'll go through it and I'll explain why it's written the way it's written. And I don't think the authors of that short report are schooled in rhetoric. But in anybody attempting to get something done like appeal to your emotion, we'll use certain rhetorical tricks, and I'll explain what those rhetorical tricks are so that when you spot them in a report, you can identify them as being something that you should ignore. When an author resorts to rhetoric, to heighten emotion, it's because they are short on facts, or they're using particular rhetorical tricks, like taking an extreme case and making you think it is a mainstream case, making you think that this is exactly what is going on. It's what they don't tell you that's more important. So we'll learn how to tear one of these apart in a factual way. We'll learn where we can find the information. And in doing this, we're going to get a number of things done. We're going to learn a lot about the CLO market. We're going to learn a lot about the nature of bridge loans and by default, Arbor's business model behind what they do. We're going to learn a lot about credit facilities and about loan loss reserves. And, of course, how to read a short report and how to critically assess a short report. The one written in the summer, I only have a screen name. I don't actually have the person's name. However, the screen name starts with CFA. I think in the process we'll take down a charter holder at the same time. Won't that be fun? This will be in the applied level. I won't be putting this long video on YouTube. It'll be put in the applied level in the sector studies in the financial sector, because this is a mortgage REIT, and we are going to be learning a lot about CLOs and how CLOs are structured. We'll learn a lot about pre-sale reports and surveillance reports that collateral managers issue. Collateral managers have to issue these things. Collateral managers are the ones that actively manage the CLOs, and these are actively managed CLOs. So we'll learn, where do we find the pre-sale report? Where do we find the surveillance report? A lot of times they're behind a paywall, but if you're clever at searching, you should be able to find the surveillance reports, and I'll show you how to find them. And if you can't find the surveillance reports, you can always find the press release for the surveillance report that gives you more than enough information. So we will see the progression of the ratings of the CLO tranches over time and see if it matches what any of these reports say. And you're going to see that there are, from both the reports, a massive lack of understanding of how the CLO works. And once we understand how the CLO works, we can go through these reports and we can just discount almost everything and say, okay, well, that's not true, and this is not true, and this is not true. But when a short report is written for a retail market, it doesn't have to be true, because the bet is that you are too uninformed to know the difference. So I really just have to appeal to your emotion. So we're going to have a lot of fun with this. It's going to be long. I've got well over 20 screens to get through. I think at last count I was at 20 or 21 screens, and a bunch of exhibits to get through. And we also have to read some methodologies. The rating agencies' methodologies for how they rate these things, because hidden in the methodology is something we need to know. So you will get a lot out of this. So again, it'll be in the applied level, in the sector studies folder. Within that folder, it'll be in the financial sector, because this is a mortgage REIT. I've already moved the 2 ABR videos I had done before to the sector study, so you may want to view them first. And then we will go through the short report. What I am going to ask you to do at the beginning of the video, I'll tell you now. So I will give you the address, the web address of where the more intelligently written, I say intelligently written because I do feel that the author was doing a good job given the best understanding that they had. Well, I'll show you where that is, and then I want you to read it first before watching the video. And then I want you to note how you feel. And I'm absolutely certain after you read it, you're going to want to dump your shares. You're going to say, get me out of this thing, get me out right now. Oh my God. That's the point. That's the point of it. If you want to read the Viceroy one first, go ahead and read that one. But that is designed to scare you. And after reading it, you probably would say, get me out of this thing right now. Don't do anything. Do not do anything. Watch the video first. Listen to my calming, soothing voice, and I'll talk you down off that cliff. Okay, let's have a look at what the Fed told us today. All right, we're going to start with the staff economic outlook, and it looks like I got a whole bunch of stuff highlighted here, like we'll be reading for a while. Not really. We're going to go through the staff economic outlook. I think it's important to go through that. And then we get to the participants. This is the FOMC committee members. The participants' view on current conditions and the economic outlook. We're not too concerned about them repeating the current economic conditions or financial conditions. We're aware of that. We're more interested in what they feel their outlook is based on that. So notice that as we continue on, it'll be snippets here and there that I've highlighted. On the next page, again, just a few little snippets that I highlight. And on the last page, this last column is what they did. That'll be it. So it's not like we gotta get through a lot here. So you'll recall earlier in the year, the staff was forecasting a recession. They pulled the forecast of a recession, I think back in September, the September meeting. The recession was gone. The staff was no longer forecasting a recession. Let's see what they're doing now. Now, this is the staff that supports the FOMC. They do a lot of research, they produce a lot of output, and then they feed that up to the FOMC members, who then look at it and say, okay, well, that's what the staff is thinking. The staff expected fourth quarter GDP growth to slow markedly from its third quarter rate. All told, however, average GDP growth over the second half of the year was projected to be a little faster than the first half's pace. The staff also expected output in the fourth quarter to be temporarily restrained by the auto workers' strike before being boosted in the first quarter as lost production begins to be made up. With the lagged effects of monetary policy actions expected to restrain activity, real GDP was projected to rise more slowly than the staff's estimate of potential over the next 2 years, before rising in line with potential in 2026. The unemployment rate was expected to be roughly flat through 2026 as the effects of below potential output growth were offset by the effects of further improvements in labor market functioning. I'm not sure what they're seeing. I can't get in line with what they're talking about here. Total PCE, price inflation, was expected to be close to 3% by the end of this year, and core PCE inflation was expected to be around 3.5%. All this from the perch of November 1st with 60 days left. I mean, at least they can forecast that. That's only 60 days away. How bad can it be? Inflation was projected to move lower in coming years. I still don't think years. I still think months. I still think they're too tied to their economic models. In coming years, as demand and supply and product and labor markets moved into better alignment, in 2026, total and core PCE price inflation rates were expected to be close to 2%. 2026, okay, closer to 2%. I would hazard a guess that it would be less than 2%, that by 2026, I think they're going to be more concerned about deflation. The staff continued to view the uncertainty around the baseline projection as elevated. Risks around the inflation forecast were seen as skewed to the upside, given the possibility that inflation might prove more persistent than expected, or that additional adverse shocks to supply conditions might occur. The risks to the forecast for real activity were viewed to be skewed to the downside. I'll agree on that for real activity. I just can't agree with them on inflation. Moreover, the additional monetary policy tightening that would be necessitated by higher or more persistent inflation and the potential for greater tightening of financial conditions represent a downside risk to the projection for real activities. I'll agree with that. If they do push higher, if inflation does, which I don't expect it, but if it does resurge to the point that they do want to raise rates again, then yes, this starts to become a very real thing. Okay, on to the participants now. Participants judged that the current stance of monetary policy was restrictive and was putting downward pressure on economic activity and inflation. I guess they didn't see the Q3 report. I think they're right on inflation, but in addition, they noted that financial conditions had tightened significantly in recent months. And that was because you had a bear steepener on the curve. Stressed that current inflation remained, just before you get too excited about this, saying, they're done. Stressed that current inflation remained unacceptably high and well above the committee's longer run goal of 2%. Further evidence would be required. Participants continued to view a period of below potential growth in real GDP and some further softening in labor market conditions as likely to be needed. I don't know, we really haven't seen below potential GDP or much softening in the labor market, and inflation readings just keep coming down. So I don't know. PPIs are in many countries are printing negative, which is outright deflation, not just disinflation, but deflation. Household sector, consumer spending had again surprised to the upside. If it keeps surprising, had again surprised to the upside, you would start to rethink some of the things you say. Some participants remarked that finances of some households were increasingly coming under pressure. Added that delinquencies on auto loans and credit cards had risen for these households. This is when they say under pressure. They're talking about low and moderate income categories, which is what you would expect to see with lower levels of income and rising interest and finance costs. You would expect to see that. And especially higher rents, even though rents are stabilizing, rent growth year over year isn't anything to talk about. We've still come from 2020 to 2023 where rents are some 30% higher, 40% higher. Even though they're not going anywhere, they jumped 30-40% over a 2-year period. You would expect to see this. Some participants commented that their district contacts reported a somewhat weaker picture of consumer demand than indicated by the incoming aggregate data. I found that sentence to be, very interesting. Some participants, it would be nice if they can quantify. It's not just one or a few, but some commented that their district contacts reported a somewhat weaker picture of consumer demand than indicated by the incoming aggregate data. Business fixed investment. Some participants noted that businesses were benefiting from an increased ability to hire and retain workers, better functioning supply chains, or reduced input cost pressures. That's disinflationary. Every one of those points is disinflationary. And this here is also disinflationary. If it's a somewhat weaker picture of consumer demand, then consumer demand isn't as strong as the numbers are implying. That is also disinflationary. Cost increases could not be easily passed on to customers, business contacts had reported, which means that any more upside to inflationary pressure seems to be muted. Could not be easily passed on to customers. Higher interest rates were affecting their businesses. Firms were increasingly cutting or delaying their investment plans because of higher borrowing costs and tighter bank lending conditions. And in the last quarter's earnings, as we go through some of the companies, we can see a consistent theme across many companies, especially the R&D heavier companies and the industrial companies, of cutting their R&D and cutting, I shouldn't say their R&D, cutting their CapEx, their planned CapEx spending. So we have seen some companies actually do that. The GM and Ford are pulling back on their EV investments. FCX is pulling a little back a little bit on its planned CapEx. Few participants observed that higher interest rates were also affecting the agricultural sector, with their contacts noting that high financing costs were likely weighing on the purchase of heavy agricultural equipment. And Deere, I think in that sector, the farming sector, was forecasting flat to, I think, negative 2% growth. Flat to negative 2%. Labor market remained tight. Labor supply and labor demand were continuing to come in into better balance. Labor demand, various measures appeared to indicate some easing, including a downward trend in job openings, a lower quits rate, and reduced wage premiums offered to job switchers. Every one of those things disinflationary. Participants noted that in recent months, financial conditions had tightened significantly. That's an interesting word they used. Tightened significantly because of a substantial run-up in longer-term treasury yields, among other factors. Some participants noted that the rise in longer-term yields may also have been driven by expectations for a higher path of the federal funds rate in light of the surprising resilience of the economy, or a possible rise in the neutral policy rate. However, they also noted that whatever the source of the rise, what they're saying here, we don't care. Whatever the source of the rise in longer-term yields, persistent changes in financial conditions could have implications for the path of monetary policy, and that would be therefore important to continue to monitor market developments closely. That's kind of interesting, saying that could affect not just inflation and full employment, not just those two things, but this could have implications for the path of monetary policy. So that's interesting, right? Many participants also commented on risks associated with potential sharp decline in CRE valuations. A potential sharp decline. In the office space, that's already happened. In multifamily, in many markets, that's already happened. So maybe they're pointing out that it could even be worse. A potential sharp decline in CRE valuations, which could adversely affect some banks and other financial institutions. I didn't highlight the last sentence, but let's highlight it now. In addition, several participants emphasized the need for banks to establish readiness to use the Federal Reserve liquidity facilities and for the Federal Reserve to ensure its own readiness to provide liquidity during periods of stress. So it is, for anyone who's reading that saying, oh, that's the next problem, in that last sentence, the Fed is saying, you know what we're going to do? You know what we're going to do. So everybody stop worrying about it, because the worrying about it can actually cause the problem. Here's what we're going to do. We're going to just flood the market with liquidity if anything happens. So relax. There maybe, a statement trying to say, here's what we're going to do, so don't do it. Participants commented on the significant tightening in financial conditions in recent months driven by higher long-term yields. Said twice. All participants judged it appropriate. All. I should have highlighted that word in a different color. Unanimous. All judged it appropriate to maintain the target range for the Fed funds rate at 5.25 to 5.5. Nobody was arguing for a higher rate. I think at the previous meeting, there was one or two that would have gone further, but had voted to remain the same, but would have gone further. Here, all judged it appropriate. Participants judged that maintaining this restrictive stance of policy at this meeting would support further progress towards the committee's goals while allowing more time to gather additional information. In discussing the policy outlook, participants continued to judge that it was critical that the stance of monetary policy be kept sufficiently restrictive to return inflation to the committee's 2% objective over time. All participants agreed that the committee was in a position to proceed carefully and that policy decisions at every meeting would continue to be based on the totality of incoming information and its implications for the economic outlook as well as the balance of risks. That line right there, the committee was in a position to proceed carefully. They're done. This is, as long as inflation can go sideways, and I think they're done. But it has been coming down. PPIs sort of indicating that, over the next few months we should see CPI drop. Some of the points made from their business contacts suggest at least a disinflationary backdrop beginning to appear in the economy. I've said this before in other videos. I think they're done. I think we're in phase 2 now, which is not the how high part is over, it's the how long. We're in the how long phase now. But proceed carefully, I think, is good language for their pivot from raising rates to holding rates. It's not so much of a pivot as a progression to the next phase, but there it is, right? I said the word pivot. Participants expected that the data arriving in coming months would help clarify. I highlighted this because it just seemed, at first I thought, okay, blah, 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 but then hang on. The coming months. In the coming months would help clarify the extent to which the disinflation process was continuing. So they're agreeing that this is going on. The next few months, well, I say few, it didn't say few, arriving in coming months. Doesn't sound like 3 quarters. It sounds like, the next 2, 3, 4 months, right? Aggregate demand was moderating in the face of tighter financial and credit conditions, and labor markets were reaching a better balance between demand and supply. So it could be that the forward curve if we just look at SOFR, the forward curve for 1 month SOFR might have it right. It has a possibility of maybe some kind of thinking for March. I don't think March is the right month for a cut unless disinflation really takes hold and it starts threatening deflation or something breaks significantly. But they've already said that they'll flood the market with liquidity first. If something breaks, here's liquidity. You go have a good time. If you're sad, here's some alcohol. I don't need to do anything else. Just go drink it away. That's what they'll do. But Q2 clearly has 1 rate cut in the forward curve. Q3 has 1 rate cut, and Q4 looks like it has 2. I'm sort of leaning towards agreeing with that I think that they have it right, and maybe not right enough, but at least 4 cuts, 100 basis points over 2024. I would say, yeah, I can see that, at least that. I agree with that. All participants judged that it would be appropriate for policy to remain at a restrictive stance for some time until inflation is clearly moving down sustainably towards the committee's objectives. So I guess we have to think about, well, what do you mean by sustainably? What does that mean to you guys, sustainably? A few participants noted that the process of balance sheet runoff could continue for some time, even after the committee begins to reduce the target range for the federal funds rate. Stop right there. The target, if we're going to stay in what's called an ample reserves regime, which is where this Federal Reserve wants to be, in an ample reserves regime, because monetary policy is easier to conduct when you're in the part of the curve. Well, it's hard to explain without drawing a picture, and I don't have the tools here to draw a picture, but it's thought that if that's somewhere around $6.5 trillion on the Fed balance sheet. Now the SOMA is sitting at under 7.2, and the whole balance sheet I think is heading down towards 8 trillion, or maybe just a little under 8 trillion, somewhere around there. So if we think about 65 billion a month for another 700 billion, that's somewhere in the next 10 to 11 months that they would then start thinking about stopping balance sheet runoff, right around 6.5 trillion. But read this paragraph again. They noted that the process of balance sheet runoff could continue for some time, even after the committee begins to reduce the target range for the federal funds rate. To say that, you must have some idea that, well, listen, we can go another 10, 12 months on balance sheet runoff. We can continue that even after we start cutting rates. So that to me almost hints that they also expect sometime in the next 10 to 12 months that they are going to start cutting rates, if we think about 6.5 trillion as their destination place for the balance sheet. I'm going to do a little bit more reading and digging on that to see if I can find something from the Federal Reserve that gives me more clarity on that. And maybe if I can find something, I'll update it on the market outlook on Sunday. Last paragraph here. Many participants commented that even though economic activity had been resilient and the labor market had continued to be strong, downside risks to economic activity remained. Such risks included potentially larger than expected effects of the tightening in financial and credit conditions on aggregate demand and on bank, business, and household balance sheets, continued weakness in the CRE sector, and potential disruptions to global oil markets. Again, this is just one more sentence at the end that makes me feel that they are done. They're more concerned now, I think. They say their risks are two-sided, are balanced. Yeah, we're concerned about inflation, but now we're equally concerned about economic growth, that they are balanced. And if they're balanced, then there really is no need to go any higher. As soon as the balance shifts to economic growth and inflation fades to the background, that's when the conversation of cutting begins. And I'm in agreement with the SOFR curve that by the end of the second quarter, we will have seen the beginning of phase 3, which is the cutting phase. So we've got maybe one and a half quarters of where we are before we can, I think, start having the conversation of, well, is it the next Fed meeting? And the probabilities, I think, will start showing up for negative 25 basis points instead of 0 and positive. We'll start seeing probabilities to the negative side. Anyways, that is the minutes.